Most traders believe their biggest problem is strategy. They believe they need better indicators, a better system, a more precise entry, a more reliable signal. They believe somewhere out there is a setup that will finally remove the uncertainty. But something strange keeps happening. You can show a trader the exact rules of a profitable system. You can explain the entry, the stop, the risk, the probabilities. They understand it. They agree with it. They even promise themselves they will follow it. And then the moment real money is at risk, something changes. They hesitate when the signal appears. They close the trade early when it moves in their favor. They move the stop when the loss approaches. They take trades that were never part of the plan. It looks like a discipline problem. But the deeper problem is not discipline. The deeper problem is that the moment risk becomes real, the brain stops experiencing the chart as information and starts experiencing it as threat. And when the brain senses threat, it does not optimize for statistical execution. It optimizes for emotional relief. This is the first thing most traders never fully understand. The difficulty of trading does not come from analyzing the market. It comes from managing the internal reaction to uncertainty. Your brain evolved to survive danger, not to manage probabilities. For most of human history, uncertainty meant something very specific. If you heard movement in the dark, uncertainty meant there might be a predator. If food was scarce, uncertainty meant survival might be at risk. In those environments, hesitation could be fatal. Loss could be catastrophic. Mistakes could not be repeated many times. So the brain developed powerful mechanisms to avoid pain and seek safety as quickly as possible. The problem is that financial markets operate in a completely different environment. In trading, uncertainty is not a signal of immediate danger. It is the normal structure of the game, but the brain does not interpret it that way. Every time you place a trade, you expose yourself to potential loss, and the brain interprets potential loss as a form of threat. Not theoretical threat, emotional threat. Researchers have repeatedly shown that losing money activates the same neural pathways associated with physical pain. The brain does not treat financial loss as abstract information. It treats it as something that must be avoided. Now imagine what happens when a trader enters a position. At first, the trade is neutral. It is simply an idea expressed in the market. But the moment price begins to move against the position, something changes internally. The brain starts asking a different question. Not what does the system say to do, but how do I stop this discomfort? This is where most trading behavior becomes distorted. When the brain is under perceived threat, it begins to search for relief. Relief can take many forms. Closing the trade early provides relief because it removes uncertainty. Moving the stop provides relief because it delays the moment of loss. Skipping the next trade provides relief because it avoids the possibility of pain. Even overtrading can provide relief because action creates the feeling of control. From the outside, these behaviors look irrational. But internally, they make perfect sense. The brain is not trying to maximize long-term expectancy. It is trying to reduce immediate emotional pressure. And this creates the central conflict of trading. Your system operates on probability across a large series of trades. Your brain operates on emotional comfort in the current moment. Those two processes are fundamentally incompatible unless the trader learns to regulate the internal response to risk. This is why knowledge alone does not solve the problem. Most traders already know they should not move their stop. They already know they should let winners run. They already know they should follow their rules. But knowledge exists in the thinking mind, and the moment financial risk activates the threat response, behavior is no longer controlled purely by thinking. It becomes controlled by the nervous system. The nervous system does not care about your strategy. It cares about safety. And when safety feels uncertain, perception begins to change. You start looking at the chart differently. Signals that once looked clear now look dangerous. Normal pullbacks suddenly look like reversals. Small fluctuations begin to feel significant. This is why traders often say the market feels unpredictable. In reality, the market did not change. Their internal state changed. And once the internal state shifts, interpretation shifts with it. The brain begins searching for confirmation that matches the emotional state. If the trader is afraid, the brain looks for danger. If the trader is hopeful, the brain looks for reassurance. This is why a losing trade often leads traders to find reasons to stay in the position. They open different time frames. They reinterpret price action. They search for information that supports the belief that the trade will recover. It feels like analysis. But the real goal is emotional protection. Admitting the trade is wrong would mean accepting the loss and the discomfort attached to it. So the brain constructs a story that allows the position to remain open. The same process happens in reverse with winning trades. When a trade moves into profit, uncertainty still exists. The market could reverse at any moment. The brain begins imagining the pain of watching profit disappear. So it searches for signs that danger may be approaching. A small pullback becomes a warning. A minor candle pattern becomes a signal to exit. The trader closes the position, not because the system said so, but because the mind wanted to lock in relief. This is why many traders experience the same frustrating pattern. Losses become larger than planned. Winners become smaller than expected. And over time, the statistical edge disappears. The trader often blames the strategy. But the real issue was never the strategy. The issue was that emotional regulation collapsed during uncertainty. Professional traders are not immune to these reactions. Their brains are wired the same way. The difference is that professionals understand something most amateurs never fully accept. They understand that the discomfort of uncertainty is not a problem to eliminate. It is the normal cost of participating in a probabilistic environment. Once this becomes clear, the goal of trading changes. The goal is no longer to feel certain. The goal is to remain stable while uncertainty exists. A professional trader does not try to remove risk from the market. They focus on preventing risk from destabilizing their internal state. Because once the internal state remains stable, behavior remains consistent. And consistent behavior is the only way a statistical edge can actually express itself over time. The edge itself is rarely complicated. Many profitable systems are simple. What is difficult is staying psychologically neutral long enough for probability to unfold. This is why the same system can produce completely different results in the hands of different traders. One trader follows it with calm repetition. Another trader interferes every time the emotional pressure rises. The chart is identical. The rules are identical. But the internal experience is completely different. And in trading, the internal experience quietly determines the outcome. If you observe traders long enough, a strange pattern begins to appear. Most traders do not lose because they do not understand their strategy. They lose because they cannot remain psychologically stable long enough to execute it. At the beginning, many traders approach the market with excitement. They believe the challenge is intellectual. They assume success will come from understanding charts better than other people. So they study patterns. They test indicators. They learn about structure, support, resistance, momentum, but eventually something confusing happens. Even after they understand their system, their behavior begins to break down. They hesitate on valid setups. They interfere with trades that were working. They change their risk after a few losses. They take trades that were never part of the plan. From the outside, it appears like a lack of discipline, but internally, something more subtle is happening. Trading constantly exposes the mind to uncertainty, and uncertainty creates tension inside the nervous system. The brain wants resolution. It wants to know whether the decision was correct. It wants to know whether the trade will work. It wants clarity about what will happen next. But markets do not provide that clarity. In fact, markets do the opposite. Even a perfect setup can fail. Even a weak setup can succeed. The outcome of any single trade is never guaranteed. This creates a continuous psychological pressure. And most traders try to solve that pressure by searching for certainty. They look for more confirmation, more indicators, more opinions, more signals that prove the trade will work. But certainty never arrives. Because trading is not a prediction environment. It is a probability environment. This difference is small conceptually, but enormous psychologically. In prediction environments, the mind is rewarded for being correct. The goal is to analyze information and arrive at the right answer. But in probability environments, there is no single correct outcome. You can make the right decision and still lose. You can make the wrong decision and still win. And this is where many traders become trapped. They evaluate their decisions based on the outcome of the last trade. If the trade wins, they believe they were correct. If the trade loses, they believe they made a mistake. Over time, this creates instability, because the trader's confidence begins rising and falling with every result. After a few wins, the trader feels intelligent and in control. After a few losses, the trader feels uncertain and defensive. Nothing about the market changed. But the trader's internal state has changed dramatically. And once the internal state becomes unstable, behavior begins to shift. A trader who just experienced several losses will often approach the next trade with hesitation. Even if the setup is identical, even if the rules are clear, something inside the mind whispers that another loss might be coming. So the trader waits. They want more confirmation. They want additional proof. But by the time that proof appears, the opportunity is gone. Later, they look back at the chart and see that the trade worked exactly as planned. Frustration appears. Now the emotional state changes again. The trader does not want to miss the next move. So when another setup begins forming, they enter earlier than their system requires. But this time the market fails. The loss feels worse than usual, not only because money was lost, but because the trader knows the decision was emotional. This cycle quietly erodes confidence. Each deviation from the plan weakens the trader's trust in their own behavior. Eventually, many traders reach a stage where they no longer trust themselves to follow their rules. They begin searching for a better system again, not because the previous system failed, but because they believe a different strategy will somehow remove the emotional difficulty. But the strategy was never the true problem. The problem was the relationship between uncertainty and emotional stability. This becomes even more complicated when identity enters the process. For many traders, performance begins to feel personal. A losing trade does not just represent a financial outcome. It begins to feel like evidence about intelligence, skill, or competence. The mind quietly attaches meaning to the result. If the trade works, the trader feels validated. If the trade fails, the trader feels wrong. And once trading becomes tied to identity, the emotional pressure increases dramatically. Because now every trade carries psychological weight. Being wrong is no longer just part of probability. It becomes a threat to self-perception, and the brain will do almost anything to avoid that feeling. This is why traders often refuse to exit losing positions. Closing the trade would mean admitting the decision was incorrect. Keeping the trade open allows the mind to maintain the belief that the analysis might still be right. Hope becomes a form of emotional protection, but the market does not respond to hope. Eventually, the loss grows large enough that it can no longer be ignored. The trader exits in frustration, and the emotional reaction becomes stronger than if the loss had been taken quickly. Over time, this pattern produces exhaustion. Not only financial exhaustion, but psychological exhaustion. The trader begins to feel like the market is attacking them. Every decision feels heavy. Every trade feels important. Every loss feels personal. But this weight exists mostly inside the mind. The market itself is simply producing price movement. It has no intention, no memory, no awareness of the individual trader. What creates suffering is the meaning the trader attaches to the experience. Professional traders gradually learn to remove that meaning, not because they do not care about money, but because they understand something very important. The outcome of a single trade contains almost no useful information. What matters is the process repeated across many trades. This shift in perspective changes the emotional landscape of trading. When a trader believes each trade must work, every position feels dangerous. But when a trader truly accepts that losses are statistically normal, each trade becomes smaller psychologically. It becomes just one event in a long sequence. This is similar to how a casino operates. A casino does not react emotionally to individual outcomes. If a player wins a large hand, the casino does not panic. If a player loses several hands in a row, the casino does not celebrate. The casino focuses on the mathematical edge that exists across thousands of events. Because of that perspective, short-term randomness does not disturb their behavior. They simply continue operating the same process. Professional traders eventually adopt a similar mindset. They stop asking whether the next trade will work. Instead, they focus on whether they are executing their process correctly. Did the setup meet the criteria? Was the position size correct? Was the risk controlled? Was the exit respected? If the answer to those questions is yes, the trade is considered successful regardless of outcome. Because the goal is not to win every trade. The goal is to behave consistently enough for probability to reveal the edge over time. This may sound simple, but emotionally it is extremely difficult, because the human mind constantly wants immediate feedback. It wants proof that the decision was correct. It wants reassurance that the risk was justified. Trading rarely provides that reassurance quickly. Sometimes the reward arrives many trades later. Sometimes the reward appears after a long period of losses. Remaining stable through that uncertainty is the real skill of trading. Not prediction, not intelligence, but psychological stability under financial pressure. The turning point for many traders does not come from discovering a better strategy. It comes from realizing that the real battle was never against the market. It was against their own reactions to uncertainty. When most people begin trading, they imagine the challenge is external. They believe the goal is to understand price, predict direction, and outsmart other participants. But after enough time in the market, a different pattern becomes impossible to ignore. The same situations keep repeating. You know exactly where your stop should be, yet in the moment, you move it. You know your rules say to take the trade, yet something inside you hesitates. You know you should let the position run, yet your hand closes the trade early. It begins to feel like two different people are operating the account. One person understands the system. The other person interferes with it. This internal conflict confuses many traders because logically they know what they should do. But logic is not the only force controlling behavior. Under conditions of risk, the brain begins to prioritize emotional safety. When money is involved, the experience becomes personal. The mind starts projecting into the future. What if this trade fails? What if the loss becomes larger? What if I give back the profit? What if I am wrong again? These thoughts appear quickly and often without conscious awareness. They create tension in the body and urgency in the mind. And once urgency appears, patience disappears. The trader begins trying to manage the discomfort rather than follow the plan. Small adjustments feel harmless. Moving the stop a little further. Closing part of the position early. Skipping the next signal after a loss. Each action feels reasonable in the moment. But over time, these small decisions slowly destroy the consistency required for probability to work. The trader begins operating based on feelings rather than structure. Confidence rises and falls with every result, and the account begins reflecting that instability. Many traders interpret this as evidence that they need stronger discipline, so they try to force themselves to behave differently. They promise they will follow the rules perfectly next time. They tell themselves they must control their emotions. For a short period, this sometimes works. But eventually, the same patterns return, because discipline alone cannot solve a deeper misunderstanding. The trader is still trying to eliminate uncertainty, and uncertainty cannot be eliminated from trading. The market will always contain unknown outcomes. Every position contains the possibility of loss. The professional approach is not to remove that uncertainty. The professional approach is to become comfortable operating inside it. This requires a very different relationship with risk. Most traders view risk as something that should be avoided whenever possible. They want confirmation that reduces the chance of being wrong. They want additional signals that increase confidence. They want the market to prove the trade before they commit to it. But the paradox of trading is that opportunity often exists precisely because the outcome is uncertain. If the result were obvious, the price would already reflect it. Professional traders accept this reality. They understand that every trade is simply a structured risk. They are not trying to be right. They are trying to participate in situations where the probabilities are slightly in their favor. And once the position is placed, their job is mostly finished. The market will do whatever it will do. The trader does not need to predict it. They only need to respect the boundaries they defined before entering. This approach changes the emotional experience of trading. Instead of constantly evaluating whether the trade is correct, the trader focuses on whether they are respecting the process. The mind becomes quieter, because the responsibility is no longer to control the outcome. The responsibility is to execute the structure. Over time, this produces something extremely valuable. Trust. Not blind confidence, but trust built from repeated experience. The trader begins to see that individual outcomes do not matter as much as they once believed. Losses appear, but they are contained. Wins appear, but they are not chased. The account begins to move based on statistical patterns rather than emotional swings. At this stage, something interesting happens internally. The market stops feeling like an enemy. Earlier in a trader's journey, every movement felt personal. A losing trade felt like punishment. A winning trade felt like validation. But eventually, the trader begins to see price movement as neutral information. The chart is no longer an emotional battlefield. It becomes a structure of probabilities. And within that structure, the trader simply participates when their conditions appear. This does not mean trading becomes effortless. Uncertainty still exists. Losses still occur. But the emotional intensity begins to fade. The trader is no longer reacting to every fluctuation. They are observing the process unfold. One of the clearest signs that a trader is developing professionally is the disappearance of urgency. Early in the journey, everything feels urgent. The next trade feels important. The next candle feels meaningful. The trader constantly feels the need to act. But experienced traders move differently. They are patient because they know opportunities repeat. They are calm because they know individual outcomes are irrelevant. They are selective because they trust the long series rather than the single moment. This patience is not passive. It is a form of psychological stability, and stability is the foundation of consistency. Without stability, every market movement creates emotional reaction. With stability, the trader remains anchored to the process. Over months and years, this difference compounds dramatically. Two traders can use the exact same system. One reacts emotionally to every outcome. The other remains steady and executes the same structure repeatedly. Eventually, the results separate. Not because the system changed, but because one trader allowed emotion to continuously reshape their decisions, while the other allowed probability to unfold without interference. This is the quiet truth about trading that many people resist. Success does not come from mastering the market. It comes from mastering the internal experience of risk. And that mastery rarely happens quickly. It develops gradually through observation, repetition, and self-awareness. A trader begins noticing when tension appears. They recognize the moments when fear starts influencing perception. They see the impulse to interfere with the plan. And instead of reacting automatically, they learn to pause. That pause creates space between emotion and action. Inside that space, the trader can return to structure, to the rules defined before the trade existed, to the process designed when the mind was calm. This is where real consistency begins. Not when the trader stops feeling emotion, but when emotion no longer controls behavior. At a certain stage in a trader's development, something subtle begins to change. The market stops feeling like a test that must be passed. Instead, it becomes an environment that must be navigated. This shift is quiet, but it transforms the entire experience of trading. Earlier in the journey, the trader constantly seeks validation. They want the market to prove that their analysis is correct. They want trades to confirm that they are improving. They want results that reassure them they are moving in the right direction. But the market rarely provides that kind of emotional certainty. Sometimes a perfect trade loses. Sometimes a careless trade wins. If a trader depends on outcomes to measure progress, their confidence will constantly swing between optimism and doubt. Professional traders eventually detach from this cycle. They begin evaluating themselves using a different question. Not did the trade win, but did I execute the process? This distinction may seem small, but psychologically it is enormous. Because the outcome of a single trade is largely outside the trader's control. The process is not. The trader controls the entry criteria, the position size, the stop level, the decision to respect the exit. Once those elements are defined, the responsibility becomes simple. Follow the structure. Allow the outcome to unfold. When traders truly adopt this perspective, emotional volatility begins to decrease. A loss is no longer interpreted as failure. It is simply an event inside a statistical distribution. A win is no longer interpreted as proof of superiority. It is another event inside the same distribution. The trader becomes less reactive, less attached, more stable. And stability produces something that many traders underestimate: clarity. When the mind is not overwhelmed by fear or excitement, perception improves. The trader begins seeing the market more objectively. They stop forcing interpretations that match their emotional state. They stop searching for reasons to justify decisions they already made. Instead, they observe. They wait. They act when their conditions appear. Then they step aside and allow the market to decide the outcome. From the outside, this behavior can look simple, but internally, it represents a major psychological transformation. because it requires accepting a reality that the mind naturally resists. You will never know with certainty what the next trade will do. No indicator can remove that uncertainty. No amount of analysis can eliminate risk. Even the most experienced traders cannot control the outcome of a single position. But once a trader fully accepts this, something unexpected happens. Uncertainty stops feeling threatening. It becomes normal. It becomes the background condition of the environment. Just like weather for a sailor or terrain for a pilot. The trader stops demanding that the market provide reassurance. Instead, they prepare themselves to operate inside unpredictability. This preparation does not mean emotional numbness. It means emotional balance. Losses will still occur. Profits will still feel satisfying. But neither outcome will push the trader away from their process. Over time, this balanced state allows something powerful to emerge. Consistency. Not the illusion of winning every day, but the consistency of behavior. Taking valid setups, respecting predefined risk, allowing trades to reach their natural conclusion, recording results and reviewing the process. Month after month, this consistency allows the statistical edge to reveal itself. Not dramatically, not overnight, but gradually and reliably. This is the quiet path to professional trading. It rarely looks exciting from the outside. There are no dramatic predictions, no emotional celebrations, no desperate attempts to control every movement of the chart. There is simply a structured process repeated again and again. Risk defined, execution consistent, emotion observed but not obeyed. Most traders spend years trying to find certainty in the market. But the real breakthrough arrives when they stop searching for certainty and begin developing stability. Because stability allows the trader to operate clearly inside uncertainty. And once that happens, the market begins to look very different. Not as an opponent, not as a puzzle that must be solved perfectly, but as a probabilistic environment where disciplined behavior slowly compounds over time. In that environment, success no longer depends on being right. It depends on staying consistent long enough for probability to work. And when a trader reaches that point, the struggle that once defined their experience begins to fade. The chart becomes quieter. Decisions become simpler. The mind becomes calmer. And trading becomes what it was always meant to be. A structured interaction with uncertainty, where the greatest advantage is not prediction, but self-control.